All right, welcome to the deep dive. Today, we're taking a deep dive into Canada Goose, eh?
Yep, the makers of those iconic parkas.
Exactly. And we've got their 2024 Form 20F filing.
Ah, the annual report for us non-Canadians.
Right, because they're listed on those U.S. exchanges. So what we're going to do is pull out the juicy bits, like how's their business really doing, where are they headed in the future, and, what's their overall strategy?
It's all about painting that bigger picture for our listeners so they can be in the know without having to wade through all that dense financial jargon,
You got it. Think of us as your Canada Goose Sherpas.
guiding you through the financial Himalayas.
Love it. Okay, let's start with the basics. Their business segments.
All right, so they've got three main ones: direct to consumer, or DTC as they call it.
Catchy.
Then there's wholesale,
The old school way.
and then a sort of catch-all category they call other.
And right off the bat, this report highlights a major trend. They're going big on DTC.
Huge. In fiscal year 2024, their direct-to-consumer sales brought in a whopping 71.3% of total revenue.
Whoa, that's a big jump from the previous year.
Yeah, up from 66.3% in 2023. But it's not just about more sales, right? It's a strategic move for them. Higher margins, better customer relationships, tighter control over their brand.
It's like going from selling your stuff in some random department store to having your own fancy boutique.
Exactly. You control the experience, the story, everything.
And to do that, they've been busy building out their own store network.
Oh yeah, big time. Remember, back in 2016, they only had one store.
One lonely store in Canada.
Now, fast forward to the end of fiscal 2024, they've got a global network of 68 stores spanning 13 markets.
That's impressive growth.
It is. Just last year, they added 14 new permanent stores and converted 3 temporary ones into permanent ones, too.
So where are they focusing this expansion?
Primarily the U.S. and mainland China. Clearly, those are the markets where they see the biggest potential for growth.
Smart move.
Yeah.
And of course, we can't forget about their online presence.
Absolutely. That's a crucial part of DTC these days. They've got e-commerce operations in over 50 markets.
They're going for that whole omni-channel thing, right?
Exactly. A seamless experience, whether you're shopping online or in one of their fancy stores.
But it's not all sunshine and roses in DTC land, is it?
Not quite. They're seeing some regional variations in performance.
Like some areas are doing better than others.
Right. Their Asia-Pacific segment, especially Greater China, is doing fantastic. Strong domestic demand, tourist dollars flowing in, plus they had a big boost from Lunar New Year sales.
And let's not forget, they didn't have those COVID restrictions holding them back like the year before.
Exactly. So Asia-Pacific, booming. But then you look at North America and EEA.
Europe, Middle East, Africa.
Right. They're seeing weaker comparable sales growth there, more cautious consumers, lots of promotions going on. It's a tougher market.
And their e-commerce sales in those regions took a hit too, huh?
Unfortunately, yes. Though the strong performance in China helped to offset that somewhat.
So how are they planning to keep the momentum going in the strong regions and, tackle the challenges in the weaker ones?
Well, their DTC growth strategy seems to have two main prongs. First, they're laser-focused on squeezing every ounce of performance out of their existing stores.
Make those square feet count.
Exactly. Boost sales per square foot, maximize efficiency, all that good stuff. And second, they're being super picky about where they open new stores.
No more random locations.
Nope. Prime locations only. High foot traffic, the right mix of nearby businesses, a good economic climate.
Gotta love a strategic approach.
Okay.
Now let's talk about wholesale, their other big channel.
So wholesale is interesting because it's actually shrinking, strategically shrinking.
They're deliberately moving away from it.
That's right. In fiscal year 2024, wholesale made up only 23.4% of their total revenue, down from 30.7% the year before.
So why ditch the middleman?
Well, it comes back to control. With DTC, they have direct relationships with their customers. They can shape the brand narrative, curate the experience. It's all about owning the story.
Makes sense. But the report also mentions some risks associated with wholesale.
Right. Oh, yeah. There are definitely some inherent challenges. First off, they're relying on other stores to present their products properly. They don't have direct control over that.
It's like trusting someone else to tell your story.
Exactly. And then there's the issue of commitment. There are no long-term purchase guarantees from these wholesale partners. They could easily switch to a competitor if they felt like it.
Ouch.
And let's not forget the overall state of the retail industry. It's a tough environment out there. If their wholesale partners are struggling, that's going to impact Canada Goose too.
So it seems like this shift to DTC is partly about mitigating those wholesale risks.
Exactly.
Yeah.
Taking control of their destiny, so to speak.
Now let's move on to that mysterious other revenue segment. It sounds kind of small, but it actually grew a lot.
It did. We're talking a 97.2% increase in fiscal 2024.
Wow. What's driving that growth?
Well, it's a bit of a mixed bag. They've got their employee purchase program, which has been expanding.
Makes sense. Give your employees a nice discount.
Right. And then they've also been doing more of those friends and family sales events.
Smart way to move inventory that's not flying off the shelves.
Exactly. Plus, they've now got the revenue from their Paola Confetti acquisition.
That fancy Italian knitwear brand?
Yeah, that's definitely adding to the other segment's growth.
So it's a small but mighty segment.
Yeah.
And it's growing fast.
It's one to watch, for sure. It could become a bigger part of their business in the future.
All right, stepping back a bit, what are some of the big picture strategies Canada Goose is pursuing right now?
Well, they're definitely all in on that global retail expansion, both online and brick and mortar.
World domination, one park at a time.
Pretty much. And they're really focusing on the customer experience, making it seamless whether you're shopping online or in a store.
That omni-channel magic again?
Right. And of course, they're always innovating with new products. They want to be more than just a winter brand.
Appeal to those spring and summer shoppers, too.
Exactly. And they're putting a lot of effort into streamlining their supply chain, consolidating manufacturing, bringing some production in-house, optimizing their distribution. They're even exploring new sources for raw materials.
Cutting costs, becoming more efficient.
Exactly. And don't forget their commitment to sustainability.
Oh yeah, that's a big one these days.
They're using more preferred fibers and materials, sourcing their down responsibly. They've even got a re-commerce platform now, so people can buy and sell pre-owned Canada Goose gear.
Keeping those parkas out of landfills.
Exactly. And they're working on more sustainable packaging solutions, too.
So they're taking a lot of boxes, both from a business and a sustainability perspective.
It's a good mix.
But even with all these great initiatives, they must be facing some serious challenges, right?
I know, absolutely. The competition in the outerwear market is fierce. Lots of established players with deep pockets.
It's a crowded field.
And forecasting demand is always tricky, especially with their big push into DTC. If they get it wrong, they could end up with too much inventory or not enough to meet demand.
And technology is always a risk these days.
Cyber attacks, system failures, you name it.
It's a digital minefield out there.
And let's not forget those good old-fashioned business challenges.
Like what?
Well, they've got to maintain good relationships with their wholesale partners, keep them happy.
Yeah, don't burn any bridges.
And then there's the ever-changing world of marketing and data privacy laws.
Keeping up with all that is a job in itself.
Plus, they're heavily reliant on their senior management team, especially their CEO.
If he leaves, that could be a problem.
It could create some uncertainty. And then there's their debt.
Ah, yes, the dreaded debt.
Interest rates could rise, making those loans more expensive. And they've got some restrictive covenants on their borrowing agreements, which could limit their flexibility.
So lots of potential pitfalls to navigate.
It's the life of a global business, I guess.
Okay, so we've covered how the business works and some of the big trends and challenges. Now let's get into the nitty-gritty. How do they actually perform financially?
Let's dive into those numbers.
All right, starting with revenue, what was the top line?
For the fiscal year ending March 31st, 2024, they pulled in $13,330.1 million in total revenue.
That's a pretty healthy increase.
Oh yeah, up 17.2% compared to fiscal 2023. And their fourth quarter was even stronger, with a 22.1% jump in revenue.
So things are moving in the right direction.
They are. And as we discussed earlier, direct-to-consumer was a big driver of that growth.
Those fancy stores and the online channels paying off.
DTC revenue grew 17.8% for the full year and a whopping 19.3% in the fourth quarter.
So their bet on DTC is paying off.
It seems to be. Meanwhile, wholesale revenue was a bit more flat, up 0.3% for the full year, and it actually dipped 12.1% in the fourth quarter.
Reflecting that strategic shift away from wholesale.
Right. But that other segment, that little engine that could, grew a massive 97.2% for the year and 89.7% in the fourth quarter.
Small but mighty indeed. Now let's talk about profitability. What about their gross profit and gross margin?
Gross profit came in at $915.1 million for fiscal 2024, a nice 20.1% increase. And their gross margin, which tells us how much profit they're making on each parka they sell, improved to 68.8%.
Up from 67% the year before? Not bad at all.
It's a good sign. And that improvement is largely thanks to their focus on DTC, which, as we mentioned, generally has higher margins than wholesale.
So selling direct is good for the bottom line. But what about those operating expenses? Those can eat into profits pretty quickly.
So yeah, their SG&A expenses, selling, general, and administrative, did go up.
By how much?
They increased by 18.8% to $792.9 million for the full year.
And that's mainly due to...
Those investments they're making, especially in their retail expansion. More stores means more staff, more rent, all those lovely expenses.
You got to spend money to make money, as they say.
And they're also spending more on technology, those friends and family events we talked about, and that transformation program.
So are these just one-off costs, or should we expect them to continue?
Well, the transformation program costs, those are likely to be temporary. They spent $40.1 million on it in fiscal 2024, but a lot of those were related to things like consultant fees and severance packages.
Makes sense.
But the costs associated with their retail expansion, those are probably going to stick around as they keep opening new stores.
Fair enough. So how did all these moving parts affect their operating income?
Well, their operating income actually went down 15.7% to $124.5 million for the year.
Down. But their revenue was up, and their gross margin improved.
True, but those higher operating expenses took a bite out of their profits.
Makes sense.
And their operating margin, which is just their operating income as a percentage of revenue, fell to 9.3% from 12.1%.
So they're making less profit on each dollar of sales.
Yeah, but it's worth noting that their fourth quarter was actually quite strong. Their operating income jumped 31.3% to $23.1 million, and their operating margin ticked up to 6.5%.
So maybe those investments are starting to pay off.
Could be. Now, let's look below the operating income line at some of the other key financial items.
Like what?
Well, their net interest costs, which is basically how much they're paying to service their debt, went down 9.8% for the year.
Always good to see those costs going down.
But they did spike in the fourth quarter.
Oh, how come?
It was mainly due to some accounting adjustments related to their Japan joint venture.
Those can be tricky.
They can.
Huh?
But the bottom line is their net income for the full year was down 15.7% to $58.1 million.
So a bit of a mixed bag on the profitability front.
It is. Now let's move on to the balance sheet. This tells us about their assets and liabilities, what they own and what they owe.
Got it. So what are the key takeaways here?
Well, one notable change is their cash position. They ended the year with $144.9 million in cash, down from $286.5 million the previous year.
Cash is king, as they say. So why the decline?
It's hard to say for sure without more detail, but it could be due to a number of factors. They might be investing more in their business, paying down debt, or just holding less cash overall.
And what about their inventories? Those fluffy parkas got to be taking up some space.
Their inventories actually went down, too, to $445.2 million from $472.6 million.
Less stuff sitting around in warehouses. That's usually a good thing.
It can be. It means they're managing their inventory efficiently, not overproducing and getting stuck with a bunch of unsold goods.
Makes sense. And what about their overall assets and liabilities?
Both went down slightly. Their total assets decreased to $1,481.6 million, and their total liabilities fell to $1,058.1 million.
So they're shrinking a bit, but still a sizable operation.
Oh yeah, no doubt about it. And lastly, let's touch on their cash flow statement. This gives us insights into how they're generating and using cash.
Okay, what's the story there?
Well, the report mentions that their cash flow from operations, which is the cash they generate from their core business activities, tends to be strongest in the third and fourth quarters.
Makes sense. That's their peak selling season.
Exactly. That's when those parkas are flying off the shelves and they're collecting cash from their wholesale partners.
And conversely, their working capital needs, which is the cash they need to fund their day-to-day operations, tend to be higher in the first and second quarters.
Right. That's when they're ramping up production for the upcoming season, buying raw materials, all that good stuff.
So it's a seasonal business with cash flowing in and out at different times of the year.
Exactly. Now let's talk about shareholder value. How is Canada Goose rewarding those who own their stock?
Dividends, buybacks, all that jazz.
So they've got an active share repurchase program in place. Their board authorized them to buy back up to almost 5 million shares between November 2023 and November 2024.
So they're taking shares off the market.
Yep. And any shares they buy back will be canceled, which can boost earnings per share and make the remaining shares more valuable.
Smart move. And did they actually buy back any shares during fiscal 2024?
They did. They bought back over 7.8 million shares, spending $17.8 million in the process.
So they're putting their money where their mouth is? What about dividends? Are they paying those out?
Not currently. The report mentions that their loan agreements restrict their ability to pay dividends.
So no cash payouts for now. But they are buying back shares, which is a good sign.
Definitely. Okay, so we've covered a lot of ground here. Let's zoom out and assess Canada Goose's prospects moving forward. What's the outlook?
Are they flying high, or are there some storm clouds on the horizon?
Well, there are definitely some positive signs. That strong growth in their DTC channel, especially in Asia, is very encouraging. And their improving gross margin gives them a solid foundation for future profitability.
So they're moving in the right direction strategically.
They are, and the integration of Paola Confecti seems to be going well, adding to their growth and potentially diversifying their revenue streams.
Good stuff.
And the commitment to sustainability could give them a competitive edge, especially as consumers become more eco-conscious.
It's not just about profits anymore. It's about doing business the right way.
Exactly. But of course, there are some challenges too. Those weak comparable sales in North America and EMEA are a concern, and their reliance on accurate demand forecasting is only going to increase as they expand their DTC operations.
Makes sense.
And that competition isn't going away anytime soon. They're up against some tough players in the luxury outerwear market.
It's a battle for the parka-wearing elite.
You got it. And then there are the broader economic risks, the threat of cyber attacks, and those restrictive covenants on their debt.
So it's not all smooth sailing.
No, but they're aware of the risks and seem to be taking steps to mitigate them.
Okay, so what's their overall game plan? What are they focusing on?
Their big goal is to become a leading global luxury and lifestyle brand. They want to be known for more than just winter wear.
Expand their horizons.
Exactly. They're investing in new product categories, expanding their retail footprint, and streamlining their operations.
All while staying true to their core values.
Right. That commitment to quality, craftsmanship, and sustainability.
So let's wrap things up. What are the key takeaways from this deep dive into Canada Goose?
Well, I think the biggest takeaway is that they're in the midst of a major transformation. They're moving away from wholesale, going all in on DTC, and trying to become a more global, diversified, and sustainable brand.
Sounds like a lot to juggle.
It is, and they're facing some headwinds along the way, but they also have a lot of positive momentum. It'll be fascinating to see how it all plays out.
Absolutely. So, a final thought for our listeners. As Canada Goose continues on this journey, how will they balance maintaining that sense of exclusivity that's so crucial for luxury brands with the need to appeal to a wider audience?
That's the million-dollar question.
It is. And how will their sustainability efforts impact their brand perception and bottom line in the long run? This report gives us a glimpse into their current state and their ambitions, but the story is far from over.
It's a story worth watching, for sure.
Absolutely. Well, thanks for joining us on this deep dive into Canada Goose. We'll be back soon with another fascinating company to explore.
Until then, happy investing, everyone.